when you get connected to a broker that way, you fall into a different category than just someone who's coming along trying to meet brokers who wants to do deals.
Welcome. This is the Lifetime Cash Flow Through Real Estate Investing podcast. This is where you'll learn strategies to help you achieve lifetime financial freedom through real estate investment. Your host, Rod Khleif, has owned over 2,000 homes and apartments, and he brings experts in all aspects of real estate investment and management onto the show. Now, here's your host, Rod Khleif.
Welcome to another edition of How to Build Lifetime Cash Flow Through Real Estate Investing. I'm Rod Khleif, and I'm very glad you're here. I know you're going to get a ton of value from the gentleman we're interviewing today. He's built a $20 million multifamily portfolio, literally from ground zero. Has also built his own syndication business to take down more properties. He was previously a real estate lawyer litigating real estate matters for about 10 years and then moved into multifamily acquisitions and syndication. Without further ado, my guest today is Jonathan Twombly. Jonathan, thrilled to have you on the show today.
It's great to be here, Rob. Thank you for having me.
Absolutely. So before we get started, maybe you can expand on your introduction there and your history, your background, and tell us a little bit more about how you got into multifamily.
Sure. For me, it was a bit of a long and winding road. As you mentioned, I'd been in commercial litigation for a long time. It had a couple of detours outside of that, since I wasn't particularly happy doing what I was doing. I'd taken a couple of years off to try other things, never really seemed to take. And I kind of started getting a little more serious about things when I got married and realized that I couldn't sort of play around anymore and try to figure out what I was going to do. When I grew up, I had to hurry up and grow up. So I went back into practicing law, though with the serious intention that this was going to be a way for me to make money while I really did the hard work of figuring out what I wanted to do. And it just so happened that shortly after I got married, the financial crisis hit, and at that point I was, just felt pretty lucky to have a job at all. So there wasn't a lot of opportunity for me to move at that time, but I was really thinking about it very seriously and talking to a lot of friends about what they thought I would be good at. And I had a number of friends who said, "Well, look, your temperament is really ideal for being an investor of some kind." And what I thought at first I wanted to do was go into finance, become an equities investor, work for a big institution. But because of the financial crisis, that just wasn't going to happen. I was
probably a good thing, right?
Yeah, well, I guess so. Given what's happened since, but it just wasn't going to happen because there I was. This is now like 2009 or 2010, and I'm a late 30s career changer who would suddenly be trying to compete with thousands of people who had great resumes and years of experience in that field who were out on the street looking for jobs, and it just really wasn't going to happen. So,
plus you didn't suffer through that crisis. You weren't like me, who really got his butt kicked in '08. You didn't have to go through that. So I think your timing was fantastic as well.
Well, I was lucky. You're right in that respect, that I did have a stable way to support myself during that time when a lot of people were really, really suffering. So I shelved the idea of going into, equities research or something and started looking into real estate. And that had been something that I'd always been interested in ever since I was a kid, but never really thought I could make a career out of. But I started kind of looking at property in my spare time, started underwriting property, and started thinking about, maybe this is where I really want to go. And then I went through kind of the same exercise. I started talking to people about my desire to get into it. And again, since my background was, working for large Wall Street law firms, my mindset was like, okay, I'm going to go work for another big institution. I'm just going to slot myself in to some role there. I never thought about doing this on my own. So I was, out there trying to meet people. Every time I met somebody who was in real estate, I'd go pick their brains and try to, figure out my way in. And I started running into the same thing, which was people saying, look, Jonathan, at your age, this isn't going to happen. I mean, there's all these guys, again, out on the street looking for jobs with a lot of experience, and you're just not going to be able to compete with them, especially in this town, which is New York. People are saying it's a really small real estate community. It's controlled by a few families. It's very difficult to break in.
Where are you again, Jonathan?
So I'm in Brooklyn, New York.
Okay, right.
Yeah.
Okay.
And I was kind of going through that process when the axe fell at my firm. I had actually been spending a while. The work had kind of dried up at the firm as a delayed reaction to the financial crisis, and I had been really sitting around not doing very much. It was very depressing, but I was trying to make the most of it, and this is when I was out there kind of doing networking, and I was starting to get the sense that the time was limited at this job, and I was increasing my networking activities. And then finally the axe did fall, quite a long while after I thought it would, but it finally did. And it was after that point that things actually started kind of picking up for me in the real estate world. A couple of really random kind of coincidences happened that pushed me in this direction. And one of them was I sat down with a very experienced real estate guy that I know, and he said to me, look, Jonathan, I'm just going to be really straight with you. There's no way you're going to get hired to do what you want to do in this town. So
right.
The only thing
go do it yourself.
Yeah, well, he didn't say that, but what he said was, the only way you're going to break in is if you meet somebody and they just take a liking to you and they say, hey, why don't you partner up with me? And that was really the furthest thing from my mind at the time. But lo and behold, a few weeks later, somebody said to me, hey, we'd met a couple times, and she said, hey, you know what, I think you're a smart guy. I'm starting my own investment firm. How'd you like to be my partner? So I started thinking back to what this other acquaintance of mine had said. He planted the seed in my mind, and I thought, okay, well, this is interesting. Let me start thinking about this. So what I did was I started asking friends whether they thought this was a good idea, kind of explain the situation to them. And I had a couple of friends who are quite successful who said, well, let me meet this partner that you're talking about. And I said, okay. I introduced them to her, and they both said, okay, we like her. If you guys decide to make a go of this, I'll give you money to invest.
Wow. Fantastic.
So
good friends to have.
Yeah, really. So I was very fortunate, but also had them, push me in the right direction. So even though I had not been thinking about doing this on my own, I thought to myself, okay, I've been told this is the only way to do it. Somebody's now offered me this opportunity, and now two friends have said they would put money with us if we did it. So I best do it.
Somebody's hitting you up to the side of the head there, I
exactly.
think,
Yeah.
And let me interject something,
Sure.
if I may, because I think this could resonate with my listeners. There are a lot of people that sit on the fence, and I know it's very, very difficult if you've been quote unquote employee for years and years and years to take that employee hat off, put your investor hat on, and realize you're working for yourself. It can be very scary, and it sounds like you really networked and got advice from people and really kind of got pushed over into, you got nudged into, your success now. And sometimes I think that happens. And so it's not uncommon to have fear and trepidation to go from what you think is a secure position, although the reality of things is that the only job security you have is between your ears. And so, but it's very hard to make that leap sometimes. And I'm glad that you described your journey the way you did, because I think that's going to help some of my listeners that are in a similar place. So tell us about your first deal. If you don't mind, let's go on to your first deal.
Yeah. So, the first deal then, this was quite a long story, because my first deal, there's my first deal, and then there's my first deal that I was able to close.
No. Good. Tell us about both of them. Tell us
Yeah.
about the one that didn't happen, because that happens to a lot of people as well.
Yeah, it was a long and winding road. So we started out with my first partner, who had brought me into her business. She and her husband had been investing their own personal money in some properties in Texas and Louisiana, and had developed a network there and understood those markets, and that was where she wanted to continue to focus. So we were looking at deals down there, and it took us, I'd say it took us a good year to find something that made sense, because we were caught in that kind of trap of, you guys are new, we've never heard of you, why are we going to show you good deals?
You're speaking of brokers. The communication
yeah.
with brokers. Yeah, got it. Sure. And everybody encounters that. Sure.
Yeah, that's a big problem, being an unknown quantity. And then, so we were caught sort of in that. Plus, at the time, this was still just a couple of years after that the bubble burst, and a lot of owners were still really unrealistic about what they could get for their properties. They were,
Sure.
Their assumptions had been that they were going to sell for X. The market had moved against them, but they weren't moving the prices accordingly. So the stuff that we did see was just really unrealistically priced. And finally, after about a year, there was a seller who just wanted to raise cash to do new things. I think he saw the opportunity in buying at that point in the market, and he wanted to free up some cash to do it. So he cut the price on one of his assets that he was trying to sell to a point where it became attractive
feasible
for us.
Mm-hmm.
Yeah. So we put in a bid on that, got that deal under contract, and before long.
How many units and where?
That was in Houma, Louisiana, and it was 120, I think.
Okay. And how were you gonna finance it? Just to give some of the basics.
Yeah. So we had, as I said, those two friends of mine who had committed capital to us. So
equity.
We were gonna, Yep. So they had, one of them we're going to do that deal for, and he was going to put down 100% of the equity for that deal.
Wow.
And we were financing the rest of it with Fannie Mae mortgage. And
okay, and who was going to sponsor the deal? How were you going to convince the lender that you guys knew what you were doing? What were your thoughts there?
So we were kind of leaning on my partner's husband for that stuff.
Okay.
So he was gonna co-sign for us, and and she had a track record herself because of the stuff that she owned with her husband. But we were also kind of bringing him into the deal to make the team look better, even though he wasn't really going to be part of this.
Sure, and that's very common for my listeners. Sometimes you have to bring in somebody. They could be called a sponsor. You bring somebody in to help you put a deal like this together, and you usually have to give them a point or two. Even if they're not involved on an operational level. But correct me if I'm wrong. That was non-recourse funding, so they really were just a sponsor. So they weren't on the hook for the note. They were just on the hook in the event there was some fraud or something illegal going on. And I think it's called what's the clause?
The bad
called?
boy carve-out.
Bad boy clause, exactly.
Yeah.
So,
yeah.
Okay, continue. I'm sorry to interrupt. I just want to kind of interject.
Yeah, please, feel free to, so I don't race through my story. If there's anything that's lost on your listeners. So we had that all lined up. We then got under contract on another deal with the same seller in Lafayette, Louisiana, and we had the other friend's money that we're going to use as the equity capital, and working with the same lender for the debt. It's basically the same structure. So we're doing two deals at the same time, set out the same way. That deal might have been slightly bigger. I don't really recall exactly.
Okay.
But it was around the same size. So two deals, 100+ units. We were all ready to go, and we got really into the final stages of.
You went through your due diligence.
We did the due diligence.
You didn't see any big issues and no big problems. No, nothing that would cause you to back out.
No. On the first deal, we went through everything. We did our lease audit. We actually hired some help to do it, to show us, professionals to kind of do it with them, to show us how to do it. And got the contractors in there to look at the property. We had everything kind of all lined up. We were, we knew what kind of work the property needed. We were actually getting cash back from the seller to do that, and
super.
It was all set up really well. The underwriting on this deal was actually so good that when I didn't want to show it to my investor because I was afraid he wouldn't believe us. So I had to kind of really make it more conservative. Even though we started out underwriting it conservatively, I had to make it even more conservative to make it plausible because it was going to do so well. The bank was very enthusiastic about it until all of a sudden one day they weren't. And they sent their, at the very end of the process, they usually send someone junior down there to look at the deal and just make sure, essentially the building is there.
Sure, they do a final inspection. And
it's independently of the engineering reports and all that sort of stuff. Right. It's just to send an underwriter down. So we're literally waiting for the last, couple of boxes to get checked before they offer us the loan and we can do the rate lock. And they say, we're not doing this deal. And of course, we say...
What was their reason?
We say, why? Well, right. the reason was, I think the reason was that they, for whatever reason, got skittish about doing deals in general for anything that wasn't like spectacular luxury Class A deal. And so they came up with this list of items for why they weren't going to do the deal, which didn't make any sense at all. There were things like, this may sound really laugh when you hear this, but they said things like the breezeways were dirty. The place was next to a golf course. They found a golf ball that had come through a window in a vacant unit, and then there were 10 down units, and they
were just literally using excuses to use that, using really lame excuses just to get out of doing the deal.
Yeah.
Well, and that killed the deal for you. Well, that's really unfortunate when you've got that much time, money, and effort invested in it. And so basically, those deals didn't happen.
So the first deal, the lender, wouldn't finance it. We weren't able to get another lender at that point. We were kind of also too inexperienced at the time to understand that this was still really a buyer's market, and we could have gotten more time from the seller if we'd needed it. But
so you could have asked for an extension and wait on the money going hard, and it just fell apart because of some inexperience as well. Then.
Yeah. Instead, we sort of panicked, and we wanted to get our deposit back, and so we terminated the deal. We had a financing contingency that we exercised, but we were still out all of our costs, and
sure, the inspections, the legal environmental,
fees, all of those things. We got some money back from the lender, but they'd used about half of our deposit with them, so we were out quite a bit of money out of pocket. Then with the second deal, we were going ahead with that. The lender was still on board for that one. Or they hadn't backed out yet. Who knows what would have happened? But we got through our inspection. We found a couple of things, which in retrospect really shouldn't have been a big issue for us, but we got a little bit skittish, and we terminated that deal. So there we were, a year and a half.
So let me stop you there for a second. If you were to go back and look at those two deals again, because the way you described them, that the underwriting was just so spectacular, you had to be even more conservative so you didn't scare your investor.
Yeah.
What would you have done differently when that first lender said no?
Well, when the first lender said no, knowing what I know now, I would have gone to the seller and said, look, no one else is bidding on your deal. We're the only game in town right now. You got to give us more time to line up another lender. And under the circumstances in that market, I'm sure that would have happened.
Right, and you could have even explained to him, this lender obviously got cold feet for some stupid reason, which happens. And we know it's a good deal, and give us the time, and it probably would have happened. They may have asked you to put a little more money on deposit, as long as you weren't risking the money. With it going hard. But okay, well, let's go on to the deal that happened. The first deal that happened.
So continuing the story. So after we lost that first deal, terminated the second deal, we had really put a lot of time and effort into, this, chasing these deals in Louisiana. And we sort of decided that we didn't really want to continue doing this together. We had some different ideas about what we wanted to do. That over the course of the year and a half that we were working together, it became clear that we had some philosophical differences and
sure.
work style differences. And we thought, okay, this is a good point where, maybe it's just time to kind of part on good terms. And so that's what we did. We wound things up. And at that point, I wasn't really sure what I was going to do. I mean, here I had spent 18 months, pursuing my own dreams of running my own business, and now I had sort of nothing to show for it at the end of 18 months. So
sure.
I went out to dinner with one of my friends who was going to invest with me and said, hey, look, I'm not really sure what I'm going to do right now. I might have to go back to practicing law to support myself. And he said, don't be hasty. Why don't you and I form a business together? And, I will provide you some money for some runway while you build the business, and, you'll give me part of the business, and we'll make it work from there. So that's what we did. We formed a new company at the beginning of 2013.
What's it called?
It's called Two Bridges Asset Management.
Two Bridges Asset Management.
Yeah,
okay.
That's the company that I run now.
Fantastic.
Fantastic.
Let me interject something, and for the listeners, the line from where you are now to success and your outcome is never a straight line, and you're always going to encounter things like you did, Jonathan. And as long as you have clearly defined goals and outcomes that you can keep at the top of your mind, even if you get knocked off track, it's just a different direction, a different path to getting to that final outcome. So obviously, your friend helped you stay on track, and now he's your partner, which is fantastic. So it's a good friend to have.
Yeah, exactly. And I think, just as an aside here, for me, it hasn't been so much as having a defined goal, but it's just been a real determination to succeed and just to not give up, and not to want to walk away when just because I got knocked down.
Exactly. Well,
yeah.
The goal is success, though. I mean, whatever
yeah.
anybody's definition of that is, and I agree. And you're going to get knocked down. You're gonna get bloodied, and that's okay. If it's not happening, you're probably dead, frankly.
Yeah.
So,
yeah.
that's so you formed Two Bridges, and tell us what happened then, how that evolved.
So we formed Two Bridges, and one of the things that I had done while I was still working with my original partner was we had been talking about, what other markets would we like to look at other than Louisiana and Texas. And I had always been interested in Charleston, South Carolina. I really liked down there. I have a lot of friends down there.
Great area.
And yeah, it's a great area. For anybody who hasn't been there, I highly recommend that you go. But I had been looking at that. I like that area, and it just happened that the 2010 census data had finally been released right around this time. And I was just looking for areas that were growing fast, and Charleston was, really one of the best, sort of highest growing areas. The whole Southeast is growing really well. So it looked like a good place to start looking around. And I started just, asking friends down there, like, hey, do you know any brokers? And got introduced to a couple people. So when I started Two Bridges, one of the first calls I made was to one of the guys I had met the previous year when I was down there, just doing some networking. So I started looking. By the time I formed Two Bridges, I was already certain that I wanted to focus on the Southeast, and so I hired this guy Tyler, who had a lot of connections down there and been in the multifamily business for a very long time, to represent me down there. And so 2013 was a year that we spent looking for deals without really a whole lot happening. Tyler and I were driving across, the state of South Carolina, east to west, north to south, looking at markets, looking at deals that people had sent to us, and really not seeing a whole lot that interested us.
Sense.
Yeah, either the market didn't make sense or the deal itself didn't make sense, and I was starting to get a little bit. Can
I stop you there for 1 second? Tell my listeners why a market might not make sense. Give some examples of that.
So, an example was we looked at Florence, South Carolina, and even though South Carolina as a whole is growing quite rapidly, there are pockets within it that aren't, and Florence is one that wasn't. It looked, I was just a little bit wary about getting into that market because there wasn't a clear kind of growth story there.
So you look for growth. You look for a market where businesses are coming in, the population is growing, jobs are growing. Correct me if I'm wrong on any of this.
No, exactly. Yeah, I mean, population growth is the thing that I really look for first. And then and often you'll see when you've got strong population growth, it's correlated with other things. I mean, businesses are coming in following the population, or the population's following the businesses, but usually you've got those two things going on at the same time. So that's it's kind of like the bottom line for me, or the first line of cutoff, I would say, is whether you've got a population that's growing, and I want it to be growing at a pretty significant clip above the national average, just because I think you sort of build in a lot of safety if you're in a market like that. It's going to be harder. It's going to be a lot harder for supply to keep up with demand when you've got a really rapidly growing population. So, all things being equal, your occupancy is going to stay good. So that's kind of what I look for.
That's good advice.
Yeah.
Okay. All right. Continue. I'm sorry to interrupt.
Yeah. So we were kind of crisscrossing the state, looking at stuff and not really finding anything. And I was really starting to get to the point where I was getting very frustrated and a little bit scared. And, here I've been now, this is almost 3 years in to this business, and I haven't closed a deal yet. And we finally caught a break, which was that Tyler, he was doing a lot of development deals on his own down there, and he finally reached out to one of his development partners. It turned out that guy had, the daughter of a really close family friend was a successful broker out in Greenville, and he introduced us to her. And that really changed everything for us, because going in with a personal introduction, from someone who is important to her, just made her treat us differently than we had been getting treated up to that point. And we drove out to have a meeting with her out in Greenville, and we walked in, we kind of talked about what we were doing, and she said, "Look, I've got this deal that just came in the door. Nobody has seen it yet. They didn't even have a broker package for it." And she said, "Why don't you guys have a look at this property?" So we drove up to see it, and we both liked it. We decided to put in an offer, and then she convinced the seller not to put just to accept the offer without putting it on the market, and there we were. So that was how we finally got that.
So that was all because of a great introduction and obviously persistence, incredible persistence. But that's quite a story. That all of that came together because of an introduction and that ability to finally connect with a broker. Is there anything you could have done to short circuit that process?
Well,
if you were telling somebody getting into the business, how to maybe shorten that timeline to get in with a broker, what would you tell them on how to approach a broker and possibly develop a relationship?
Yeah, so what I would say, and I'll just, if you don't mind me doing a little shameless plug for myself here, I actually, on my website, if you go to themortarblog.com, I'm giving away a free guide to exactly this, how to short-circuit this process and get brokers to pay attention to you. So If you go to my blog, you'll find it there. If you sign up,
and that's the Mortar blog, MORTAR blog.com.
Exactly right. So the Mortar blog, and it's so what I would advise people to do is use your personal connections. Don't limit yourself to using personal connections that are in real estate, though. That's a big mistake, because first of all, you might not have those connections, but second, a connection that if you have a common friend with a broker and your common friend has nothing to do with real estate, they have just a relationship with this person, hopefully they're a friend or a family. When you get connected to a broker that way, you fall into a different category than just someone who's coming along trying to meet brokers who wants to do deals. Even though that may be who you are, you're getting all of the social capital of the person who introduced you. And if that person is a personal friend, like, you're now coming in almost as a personal friend. And
that is great advice.
So so that's I always advise people that if you want to short circuit this process, there's other things that I also advise people to do in terms of getting your ducks lined up in a row, so that when you go to the broker, you're not going to embarrass yourself and you're not going to embarrass your friend. But assuming you've got all that stuff taken care of, and the last sort of link in the chain is getting the ear of a broker who's going to treat you seriously, going to show you good deals, if at all possible, find a personal connection with the brokers. And you'd be amazed. People never ask their friends who they know, right? You have no way of knowing who your friends know unless you ask them. So ask your friends, ask your family if they know anybody, and follow those leads up, and you'll be amazed by what you find out and the great connections you can make.
Very good advice, Jonathan. Thank you. So let me ask you, we were talking about, that's what we already talked about, your first deal. Let me ask you a question. Your underlying philosophy, is it to buy with the idea to reposition and sell, or do you like to hold long-term?
So we are definitely long-term holders.
Yeah, me too.
We like markets. Our way of looking at a deal is, would I like to own this deal 10 years from now? And if the answer is yes, then you buy the deal. If the answer is no, then you stay away. I probably by nature, but also because of all those years I spent as a lawyer, pretty risk-averse person. I like to take calculated risks, and so I am always wary about the repositioning play, because I feel like it involves a lot of timing of the market. And, if you know that you're at the beginning of a cycle, you're probably on safer ground, but you have to lay out a lot of capital. You're not getting any, cash flow while you're repositioning the deal. There's just a lot more risk involved. I like to look at deals where I think, even if I completely mistime the market, I'm going to be okay, because my time horizon is so long that, we're just going to slowly ride this thing up as we have, rent growth over the years. So the key then is to be in a market that you think has got long-term potential, and, to be in an asset that you think is in the right location, that is going to be able to take advantage of it.
Great. Okay. Is there any training or education that you did as part of this process? Or is there any that you might suggest to someone that's, thinking about taking this very seriously?
So I didn't really do any kind of formal training.
Sounds like you had a lot of time out there evaluating deals, though, which in itself is great training. Wouldn't you agree?
Yeah, that was my training was really kind of on the job.
Right.
I think I had read some stuff about due diligence and what I needed to be looking for, just to make sure that I knew what I was on the lookout for. But over time, though, I have to say I've realized that for me it makes more sense to outsource that to a management company that can throw
the due diligence or the management.
Well, the management I do also, but even the due diligence, I oversee the due diligence, but it's easier for me to have the management company that I'm using do, bring in a team to blast through the lease audit. They provide me with a report. They bring in their engineers. They do all of this. It works really well. We've got it down to pretty much to a science at this point. But I'm glad I did on the first couple deals. I did it myself because I know what they need to be doing and I know how to oversee it. But I don't feel the need to be actually running the lease audit myself. So that's one way I work. But
okay, that's good advice, and that's different people have different strategies for that, and some people want to do it all themselves. But I personally didn't even know that management companies did that as a practice, did due diligence like that. So that's news to me as well.
Yeah, every management company is different, but I think a lot of them have the capacity to do it, and they'll do it as a service to you. If
they think they're going to get the business once you close, I assume.
Yeah, or if they're already managing property for you, and they're expecting to get the next property from you, then they'll do it, and you kind of wind up with a system that you have in place that works pretty well. But I was going to say, in terms of what I studied, so there was things like that, but a lot of it was just kind of underwriting deals. Now, I can recall when I first started underwriting deals, so I had no idea what I was supposed to put in for expenses, and I had found somebody's list of rules of thumb, and I sort of used those, and it was helpful to get started, but that's really something that over time you kind of get a feel for, how much you should be spending to run a deal, and how you analyze deals. It's just, I think there's no substitute for experience there.
Sure. Yeah. And obviously when you're evaluating a deal, so there can be some real red flags when you're looking at expenses and opportunities if the expenses are really high in a particular area, like management, for example. And you can see an opportunity to a value add just by cutting expenses or possibly doing a bill back on utilities or any number of things. But so what would you say is your greatest business success? What's the best deal you've done so far?
So the best deal that we've done so far has been our second deal. Now, once we got the first deal under our belts, then we did 3 more deals in the space of 11 months. And the second deal was one that has just turned out to have outperformed our underwriting so much that it's still hard to figure out exactly how it's all happened. But
can you give some detail? Tell us about how explain what you mean by outperformed.
We thought. When I looked at this deal, and it was kind of this thing where, the brokers that sold us the first deal called us up and said, look, we've got this new deal. It's off the market. We're only showing it to a couple of people, but you got to act really fast. And we didn't even have a chance to go down there and see it before we had to make an offer. So I was actually on, Google Street View trying to figure out, and
look at it.
And it wound up being, it was funny. What I saw on Google Street View, I didn't like that much. So I wound up kind of putting in a bid that was a little bit lower than I might have otherwise put in. And I also, thought it was going to require a lot of CapEx. So I kind of, I sort of underwrote all that into it. And the deal actually wound up being much better than I thought when we went down to look at it. But we usually underwrite.
So it worked out in your favor that you didn't go look at it first.
It did, ironically.
Wow.
So
wow.
And
where is this? Where is this property?
So this one is in Simpsonville, South Carolina.
Okay.
And the property, we underwrite to get an 8% return. We offer a preferred return to our investors of 8%. And this deal, I was so skittish on that, I actually underwrote it not underwrote it to a 7, but that was the preferred return that we offered to the investors. So I was really anxious about making the preferred return. And it's wound up being that this has returned 11 or 12% to the investors since we bought it, even though I was worried that we weren't even going to make a 7.
Wow.
So it's been really, really lucrative, and it turns out that it just has a lot of very, very good characteristics, which now I try to replicate in deals, which is there's very little competition for this property. It's in a good school district, and it's in a town that is rapidly on the upswing. So this is really an opportunity for more of your working class kind of tenants to live in a good school district for a very reasonable price. So the place always stays very, very full. It's basically
because of the school district. That was a big factor in that. Very interesting.
And the access to jobs as well. But and also there's very little other places to go in the town if you want to rent. If you want to rent an apartment, so it's
how many units there?
132.
Okay.
Yeah.
Okay.
So this has been a really, really strong performer for us, and I'd say for sure that's been the best deal so far.
Okay. So let me ask this: what other members are on your team? Give me the components of your team. Give my listeners an idea of what they should be thinking about when they're putting a team together.
Yeah. So the team is, in terms of the owners of the company, it's me and my partner. Although he's silent, he's just a financial investor.
Okay.
In terms of the other members of what I consider my team, we've got our rep down there, Tyler, who sources deals for us.
Boots on the ground
in the state, and is also there in case anything should happen that for some reason the management company can't handle, and there's got to be us, there, which almost never happens. But just in case, he's there, he can jump in his truck and be there, within 3 hours. Obviously, the management company, very, very important.
Right.
We've got our.
Let me ask you. Let me stop you there for a second. So when they report to you, are there any specific things you're looking for? Is there any like how you want to be brief in your analysis, or try to limit the amount of time you have to spend analyzing what they send you? Are there certain things you look for as red flags?
Well, weekly occupancy is something that we track very, very closely. And we also track renewals going out 4 months ahead of time. So
good.
Our management company, or expirations, I should say. So our management company has, been trained to get ahead of expirations, and we're actually willing to give up some rent increases to keep tenants in place, because your turn cost, can kill you.
Absolutely, turnover can wipe out your cash flow for, a couple of years sometimes.
Yeah.
So net cash flow. I'm talking about net. Yeah.
Exactly. Yeah. So if you've got tenants in place that are good tenants that are paying their rent, you want to keep those people in your property. So we will not push rents really aggressively. We want people to to renew and stay there and continue, to pay rent and keep the place full. So so we're on top of those numbers, very, very strictly.
Okay. And do you insist on them, the management company, providing an incredible resident experience for the people that live there? The kind of assets that we focus on are, I call them safe, clean, and affordable, right? So what we want is for our tenants to feel that they have a nice place to live. And I think for a lot of people who have limited means, there are limited options for nice places to live. So we make sure that, we can't, for those kinds of properties, spend a lot of money on amenities, but we want to make damn sure that this is a place where they feel safe, they feel comfortable, they feel good with having their families there. So, that's what we're shooting for. We're looking for people to feel like, this is a place that can be home for them, and hopefully for a long time. Good.
Yeah.
Okay. So I guess we're getting near the end of the show. I was hoping that maybe you could leave the listeners, people that want to get into multifamily, or maybe just getting started, if you could give them a little bit of last bit of wisdom, one piece of wisdom before we go here.
I would say that this is a business where if you're looking to get rich quick, you should probably look someplace else. This is a business for people who are methodical and stay on top of things and are willing to be persistent and willing to take a long view. So if you want to get into this business, I really suggest that you spend a lot of time thinking about what you want to accomplish, the kind of assets you want to own, how far away from you want them to be, all those sorts of things, how you want to be perceived in the marketplace, and spend a lot of time planning. One of the things that always sticks with me is my dad, when I was a kid, we used to do a lot of carpentry and stuff together, and my dad would always say, measure twice, cut once, right? And that, that always stuck with me. I've always taken that as words to live by. Spend more time planning than executing, and I think that will see you through.
No, that's good advice. Listen, Jonathan, I really appreciate your valuable time. You've added incredible value today, and very, very grateful. And I hope we can stay in touch and keep an eye on each other's progress as we move forward.
Absolutely. I'd be happy to be on the show anytime.
All right. Thanks again, Jonathan.
Thank you
talk
very
to you
much.
later.
Take care.
All right. Bye.
Thank you for listening to the Lifetime Cash Flow Through Real Estate Investing podcast. If you've enjoyed the show, please subscribe and then take a moment to visit iTunes and leave a 5-star rating and review. For more resources to connect with us further, please visit our website at lifetimecashflowpodcast.com. Tune in next week for our next show.